So one of the most common questions that I get asked by my viewers of this channel is what investing books do I recommend reading? So I wanted to make this video outlining, in my opinion, what I think are the essential readings for all value investors, which I'll do by ranking the top 5 best books that have ever been written on this subject. And I'm actually going to split this into 2 lists. One list is going to be what I think are the widely regarded and widely accepted top 5 best investing books that have ever been written. And the other is going to be my personal list. So what I would personally recommend to people if they want to get started in investing and particularly value investing. And it's going to include some of the more famous books, but also some lesser known books that I think are very much worth reading. For example, if we're ranking books not just based on the sheer content of the book, but also just the overall popularity and the influence that the book has had on the investing community, I think we can all agree that The Intelligent Investor by Benjamin Graham is by far the best investing book that has ever been written. It is the book that is synonymous with value investing, right? And it's the book that pretty much kickstarts every value investor's journey, and pretty much every famous investor out there that subscribes to these value investing ideas, they kickstarted their journey by reading that book and really understanding the key tenets that I was proposing at the time, which at the time were pretty unique, right? This book was written a long time ago, pretty much almost 100 years ago, which at the time, a lot of these things, for example, concepts like margin of safety and the circle of competence, these weren't well-known things at the time. So it was pretty, innovative. So if we're sticking with the theme of ranking books, not just based on the content, but also the popularity and the influence it's had, I think the top 5 list would look something like this. So you would have Security Analysis at number 2, which, similar to The Intelligent Investor, is essential reading that goes very, very deep into the value investing philosophy and also gives some pretty good real world examples to apply investing knowledge. The only criticism I would have of this book is that it was published such a long time ago that it is a little outdated, I would say. For example, there's a whole section on the book, and it is a massive book. It's over 800 pages. It's very, very technical. There's a whole section on that book that is dedicated to investing in options and warrants. But this was written before the Black-Scholes model was discovered, which happened in the early 1970s. And that completely changed how the option market worked because it was really the first definitive pricing model that you could use to value any option based on the stock price, the strike price, the time to expiration, implied volatility, and also the current risk-free rate. Those are the 5 key variables that you would put into this model, and it could spit out the price of pretty much any option. It wasn't discovered until the 1970s, and options existed decades before that. The book, it talks about how you can find mispricings in options, but those mispricings no longer exist because of the Black-Scholes model, and they would pretty much just get instantly arbitraged away if they did exist. So it's not really realistic to think that you could still pull off that strategy. And there's also a lot of examples that the book gives of companies that were valued so cheaply at the time that you're probably not going to find scenarios like that ever again. Because remember, this book was written, I believe, in the 1930s, so it pulls examples kind of from the 1920s, which that was around the Great Depression era. So there's a lot of companies in there that were valued just so unreasonably cheaply at the time that you're probably not going to see again unless something, very drastic happens, like there's another world war or, God forbid, anything like that. There's one example where they give where they're talking about some small railroad stock that's trading at like 20% of its net current asset value. I don't think you're going to find anything like that ever again. And if you would, it's probably, not the same situation it was before. But outside of that, it's still very, very good at explaining the core tenets of value investing. And then at number 3, I have One Up on Wall Street by Peter Lynch. Now, this is a very, very retail investor oriented book that explains, again, what was at the time a very, very novel concept, which was, it's something that's become more accepted lately, which is that retail investors, they can use their personal knowledge that they obtain just by going throughout their ordinary life, and they can use that knowledge to make very, very smart investments. For example, let's say you work in IT and you have very in-depth industry knowledge of IT and different software products and how they work and what companies would use them for. You probably can see which ones are becoming more relevant, right? Which ones companies are starting to use more. And that's very, very valuable information that you can use to make smart investing decisions. So that's the whole idea of this book, that retail investors, that's why it's called One Up on Wall Street, that the average person does have some knowledge that they can use to benefit themselves if they choose to do so in investing. And then number 4, a book that I haven't personally read, which is Common Stocks and Uncommon Profits. Now, what I understand about this book is it's basically the Bible on growth investing, right? Which a lot of books on value investing, particularly the older ones like Security Analysis and The Intelligent Investor, these were written at a different time than we live in today, right? Nowadays, growth stocks are a lot more frequent, right? And you do have to, I guess, respect a company's growth potential if you're going to be an investor in today's market. And what Benjamin Graham saw was that growth is something that's just too unpredictable, that instead of trying to predict it, you should protect yourself from it as an investor. But this book, basically proposed, how to go about growth investing in a more responsible way. You shouldn't view growth as the devil and something that's just purely speculative, but there is a responsible way to go about it. And the book is also, it's very straightforward, it's to the point, and I think as long as you have some basic financial terminology, then it should be a fairly easy read. And the number 5 on this list would be The Little Book That Beats the Market. So this is the book that published the famous magic formula, where basically how this works is you rank all US stocks on 2 key metrics, which is earnings yield. Earnings yield is basically a reverse price to earnings ratio. So you can think of it like an earnings to price ratio, and also return on capital. And the idea is to find cheap stocks that relative to earnings that have high returns on capital, because those should be pretty good investments overall. And then you hold the top 30 or so ranked based on that for about a year, and then you redo it after a year by selling positions that no longer are on that list and buying the new ones that have appeared on that list. So the new magic formula stocks. And the book became really popular because it basically showed that if you had followed that strategy for about 2 decades, I think, before the book was published, you would have had well above average returns. I think he was proposing something like 30% annualized returns, which if you can reliably get 30% annualized returns, then you're going to be a very wealthy individual. Again, another criticism of this book is because it became so popular, the strategy doesn't really work today. And if you're looking at the magic formula purely as a stock picking strategy, I think it can lead you to invest in a lot of value traps. And that's kind of what the book talks about, right? They're giving the logic and reasoning behind why these types of companies that rank high on these 2 metrics, why these should, in theory, be good investments. But realistically, it's going to lead you, in my opinion, to invest in a lot of value traps because it pushes you towards stocks that have just come off of historically good years that are priced cheaply because investors are often correctly expecting them to do a lot worse in the near future. For example, if we run the Magic Formula investing script on my website here, this is going to give us a list of the top 20 ranked Magic Formula stocks. So we can see what these are, and personally what I would expect to see, so this is the list here, what I would expect to see is a lot of these companies would have just one recent year of very high return on capital. And the earnings yield would reflect the fact that investors don't really expect that year to continue. So we can see here are companies, it ranks the top 20. And again, we're looking at return on capital, which is this metric here, and earnings yield. So the number 1 ranked company would be the highest on both of those metrics ranked for all US stocks. And we can see there's varying companies here. There's some large companies like, for example, Bristol Myers Squibb is a pretty large drug company. But let's pick, say, this company here, Acadia Healthcare. And what I want to do is look at what their return on invested capital was in the more recent year. Because again, what you'll see with a lot of these companies is it's going to be one very high year, which we can see is the case here. So pretty much in the years before, so pretty much 2015 until 2020, 2023, this company had a return on invested capital kind of in the 6%, 7% range, which is probably about equivalent to what their cost of capital is. So the company wasn't really, adding or creating any value. But then something happened in the business, probably some cyclical high that the business went through that led to things increasing quite a lot. So then the question becomes, is this going to continue in the future, or is this a one-off year? The fact that the earnings yield is also low seems to indicate that investors would think it's a one-off year, or at least they're not going to have quite as much of a success going forward. So I think a lot of these companies, they are going to end up being value traps. And I think following this kind of investing strategy, while it can be useful in some scenarios, because if you look at the list of the Magic Formula stocks, it's definitely a short list where at least one of those companies is going to end up doing very well, or probably several, like say 5 or 6 companies end up doing very well. But a lot of companies do end up being value traps essentially. So I think it works when you look at it on a portfolio basis where you kind of just blindly invest in the top 20 and you don't do any individual research. But if you're using this as a stock picking strategy and kind of investing in companies under the same philosophy that this book tries to describe, you're probably going to end up buying a lot of value traps. And by the way, if you're wondering about this website that I'm using here, it's called tickernomics.com. This is a free website that I created that has data on all kinds of companies, financial statement data, as we can see here, and then also charts and ratios for US stocks, international stocks, Canadian stocks. And then it also has this public scripts feature where there's a bunch of scripts that all perform unique investing tasks. For example, the magic formula is one of them. So if you are interested in checking it out, link will be in the description. So now counting down my personal list of the top 5 best investing books. So at number 5, I have not really a investing book, but more of an economics one, and that is The Big Debt Crisis by Ray Dalio. And I'm pretty sure this book is actually free on Ray Dalio's website. And what it is a very in-depth look explaining how debt cycles work and kind of this ongoing boom and bust, which I think is very important context for equity investors to have. And this book really helps you make sense of the macroeconomic picture and what you can expect to see at different phases of a debt cycle. For example, knowing the context and knowing what this book explains would have been very useful looking back at the last 3 or so years. For example, let's say you have a more speculative style portfolio, and now that you know rising interest rates are something that's on the horizon, you would know how to navigate that instead of getting blindsided by it once it actually happens. So just kind of understanding the cyclical nature of everything, it makes you much more aware of the macro picture and how that can tie into individual investing. And the book does bring in several very detailed historical examples from a whole wide range of time periods that really does a good job at driving home the point. So I would highly encourage anyone watching this to give that book a read. Now, number 4 is a lesser known book that is called Accounting for Value. And I have this book in here because it's a very unique book that ties accounting into investing and analyzing companies, which honestly not a lot of books do. A lot of books just really focus on, kind of the mindset that you need to have in investing. But this book is a bit more technical and it does a great job of summarizing some of the more important areas of accounting that I think value investors would be particularly interested in. For example, there is an entire section talking about fair value accounting, which is one of the more controversial topics for investors because a lot of investors believe that this specific accounting rule set is very misleading and can lead people to make irrational decisions. And it's one of the more recent books. It was published in 2010, and it also does a good job expanding on Benjamin Graham's ideas that he talked about in books like Security Analysis and The Intelligent Investor. For example, there's a part of the book that summarizes this very well, where they're actually talking about valuing a company, the company being Cisco, under the assumption that the business never grows. And I'll read a little bit of the book. So what they say, for Cisco, the value of Cisco, assuming it doesn't grow, is $14.63. This builds in the margin of safety advocated by fundamentalists. If the shares are trading at less than the no growth price, I'm probably getting a bargain. And for all likelihood, there is some growth. But this may just be too conservative. Although this strategy may have delivered some bargains in Benjamin Graham's time, growth delivered considerable value in the last half of the 20th century, and growth characterizes the modern firm. The growth stock movement that took traction during the 1950s departed from Graham on this point, and it's been said that Graham would have missed out on some great growth opportunities in the latter part of the 20th century, for example, the IBMs of the time. And if entrepreneurs had adopted Graham's standards of prudence, business would have never been started. The future must be grappled with. Can we do better? So that's an interesting passage of the book. And they're basically explaining a point that I brought up earlier, which is that the whole Benjamin Graham, deep value investing style isn't really well suited for the modern markets because what you have is a lot of companies that are valued much more on intangible assets, right? Like IP, technology, new processes, new ways of doing business, as opposed to tangible assets. Like if you think of railroad companies or manufacturing companies, these are very easy to value because you can look at what physical assets they have and you can understand what those assets bring. Whereas things like IP are a lot more difficult to assess, but those make up a significantly larger chunk of the total, cash flow producing assets that we see in today's world. And if you look at the biggest companies in the world, a lot of them are technology companies, right? So you can't simply ignore them. And instead, you need a similar framework for how to assess these growth style companies and invest in them in a responsible way. And I think this book does a very good job of that while also tying in some pretty valuable accounting lessons. So if accounting is something you struggle with, then I would definitely recommend this book as well. So that's number four. Now, number three, oddly enough, I have Security Analysis by Benjamin Graham. So, kind of contrary to what I just said, I do have this book as number three. Now, the reason why I have Security Analysis specifically at number three is because I like to think of this book as kind of a litmus test for value investors, where if you pick up a copy of this book and you read the book and you successfully read it cover to cover, I'd say you have sufficiently proven to yourself that you have the mindset of a value investor because it's one that requires the ability to study a very niche and very particular topic at a very deep level, understand it very well, and you also have to be patient, right? Which this book is 800 plus pages of pure technical jargon, a lot of which is outdated and maybe hard to understand. So if you're patient enough to read that entire book, then I think you've proven to yourself that you have the mindset of a value investor. So that's number three. Now, number two, and I've talked about this in a prior video before, and it is expectations investing. So this was one of the books that just instantly clicked with me because it laid out essentially how I had been personally investing and how I had been approaching evaluating companies pretty much throughout my entire investing journey. And this book really, put words to the actions that I was already implementing. And the basic idea behind the book is that the price of a stock, or really the value of a company, reveals the cumulative opinions of the entire investing public. You can take the current price or the market cap and use that information to work backwards to figure out what assumptions are embedded into that price. For example, how much revenue the company will earn, what the margin on that revenue is likely to be, how much free cash flow they will generate, all those things. And you can use that information as a benchmark to determine whether or not the assumptions currently priced in are reasonable in your view. And if you think they're unreasonable, then that may present an opportunity to either buy or short a company. And I think when you view investing this way, it really helps you rationalize why a company is valued the way it is. For example, instead of just investing in a company because you say they're innovative, I like their technology, they're doing cool things, I like the CEO or whatever, this allows you to actually put some sense into it and have actual numbers behind your decision. And what it also helps you to do is it makes the decision to sell a company a bit easier because you can benchmark what assumptions you had for the company, what you expected them to do in terms of revenue, earnings, cash flow, all that. You can look at how that develops each quarter as they release the results, compare that to what you expected, and then you actually have some reasoning and logic behind whether or not you were right or wrong about a company. Because if you were right and they perform as you expected them to, then that should work out well in your favor. You should earn the returns that you were expecting yourself to return. So it's a book that really helps you make sense of investing. And it's a pretty short read. It's very straightforward and to the point. And it also comes with a lot of online modules to help you implement these ideas a bit better. So definitely, in my opinion, one of the best books on investing that I personally have ever read. And finally, my personal number one favorite book on investing is Margin of Safety by Seth Klarman. So this book, it actually has a pretty interesting history behind it. So basically, Seth Klarman, who now is a very famous, very well-known investor, he appears on CNBC, he does interviews online, he's given speeches. He wrote this book in the early 1990s before he got really famous, pretty much decades before he got famous. And when he initially published it, it didn't sell very well. It only sold, I think, a few hundred or maybe a few thousand copies. So the publisher pulled it and it was no longer being sold. Then, decades later, as Seth Klarman got more and more famous, as he had very strong results as an investor, the book also became more and more popular. And today it's basically considered one of the classics on value investing. But because there's so few copies that got printed of this book, the book itself is actually very, very expensive and it even has some collectible value now. And copies of this book are literally selling for thousands of dollars on eBay just because there's so few of them out there. And because of this collectible value it has, you can essentially invest in a book about investing. So I thought that was pretty funny. But anyways, the reason why I have this book at number one is because it is the best book that I read that combines kind of the conceptual, the mindset aspects that you want to have as a value investor, kind of the more qualitative stuff that a lot of books talk about, but it also combines that with more technical things. And it's definitely the best book I've read at combining those two things. And the author gives actual real world examples of investments that they made where they explain everything, right? They explain their reasoning, why they found a particular company, how they evaluated it, they outline the risks. inherent in that company and why they're okay with those risks. And then they actually describe how the investment worked out like they said it would and how they earned, pretty strong returns. And there's not many books that do that, right? A lot of books, they're written by professors or they're written by people that just back tested a certain investing strategy over a given period of time. There's very few books that were written by practitioners that have had very strong results for a long period of time and explain their thought process in that much depth. So that's why I have the book at number one. And a lot of the examples it gives are kind of these special situations that you would call, right? And there's one example where he talks about a spinoff that occurred where investors were receiving shares in the spun off company on about a 20-for-1 basis. The spun off company shares were trading at about 1/3 of net current asset value. So it was basically a net stock, as you would call, or a deep value stock. And the reason it was a net stock wasn't just because, investors were asleep at the wheel and they didn't know what was going on. There was actually a solid reason behind it. And the company itself, it was a defense contractor that was currently locked into some pretty unfavorable contracts that required them to tie up a lot of their capital. A lot of them were unprofitable as well. And then in addition to that, they also had the $7 million ongoing expense that they had to pay to the parent company that they spun off from. And that would last each year for the next 5 years. And that was a pretty material amount for this company, given the size of this company. I believe it was maybe a $1 or $2 billion company in terms of market cap at the time. But what Seth Klarman realized, and he explains this in the book, is when you projected this company's free cash flow beyond the next, say, 5 years, when they're locked into these unfavorable contracts and they have this large ongoing expense that they're required to pay by law to the company they spun off from. Once you project beyond those years, what you're left is basically a pretty normal business that should, unless something else goes horribly wrong, be significantly more profitable than it is today. So as long as they can get through that one like really poor period that a lot of investors seem to focus on, then they should end up being a pretty good investment overall. And then, so that was his reasoning. And then he actually explains, what ended up happening. And it was within, I think, 2 or 3 years, his investment ended up tripling in that company, and then he sold it. So there's a few examples like that. Like I said, there's very, very few books that actually go in depth like that and explain why I bought this company, what I was thinking before I bought it, and then I was actually ended up being right about it, and I made pretty good money as a result. So yeah, those are my recommended readings. I hope you guys did find this video useful. And with that in mind, I'll see you in the next one.